Good morning, everyone. Our agenda today is to review our current fixed mortgage pricing strategy in light of the recent inflation data, swap rate changes, wholesale funding pressure, and uncertainty surrounding the future path of the OCR. We are looking to adopt a hawkish or tightening risk perspective. We expect inflation to remain persistent, likely causing the OCR to remain higher. Wholesale funding costs are likely to remain elevated over the next 1 to 3 years. Our objective today is to determine how the bank should respond when setting out the mortgage rates while balancing profitability, competitiveness, and risk management. Given we have some new members, let's quickly introduce ourselves.
Good morning, everyone. I'm Tiffany Park, the Chief Economist.
And I'm Alex Lee, the risk manager in charge of asset liability and management.
I'm Han Ho, Head of Treasury.
I'm Fu Kaiji, Head of the Retail Banking and Mortgage Lending.
And I'm Carl, CEO of today's meeting. Tiffany, could you begin by outlining the current economic outlook?
Thank you, Carl. From a macroeconomic perspective, inflation remains a key concern. The most recent CPI came in at 3.1% as of April, which is sitting above the RBNZ's 2.2% target. Importantly, domestic inflation pressures remain persistent, where services and non-tradable inflation have proven sticky. Elevated oil prices and ongoing geopolitical tensions, these risks keep inflation elevated for longer than initially expected. On GDP has slowed materially and the unemployment stands at 5.3%. Many borrowers are still struggling over COVID-era mortgage rates onto significantly higher repayments. However, I want to emphasize that the fixed mortgage rates are forward-looking. They're not simply a function of today's OCR at 2.25%, but rather they reflect market expectations and where inflation and monetary policies are headed over the next coming years. This has kept swap rates relatively elevated and put upward pressure on fixed mortgage pricing. I'll take a hawkish stance where the risk of repricing too low and facing margin compression is greater than the risk of being slightly uncompetitive in the short term.
Hanzai, how is this affecting our funding costs and mortgage pricing strategy?
Thanks. Building on our hawkish view, let me explain what this means for funding. Fixed mortgage rates are forward-looking. We're not pricing only from today's OCR. We are pricing based on where the market expects the OCR to go. Under the hawkish view, the market is already pricing in higher rate risk. The chain is simple. OCR expectation push up swap rate rise wholesale funding cost, and those costs flow into fixed mortgage rate. This is already squeezing our margin. Since March, the 2-year swap rate has risen by about 70 basis points, but our advertised 2-year mortgage rate has only increased about 20 basis points. That leaves roughly a 50 basis point gap. My recommendation is to reprice now. We should raise the 2-year and 3-year fixed rate to rebuild margin, but keep the 1-year rate competitive to protect customer retention. The Treasury should also lock in term funding before expect hikes make it more expensive.
Alex, what concerns do you have with this approach?
Well, my main concern is that markets may evolve more differently than we anticipated. While the economy is slowing, inflation remains uncertain due to higher oil prices and geopolitical tensions creating more risks. If inflation proves more persistent, the Reserve Bank is more likely to keep OCR higher for longer, pushing up long-term rates on wholesale funding and swap rates. Offering discounted fixed mortgage rates may increase our market share, but the banks may face margin compression as funding costs have an upward trajectory, which may lead to the bank run like in Silicon Valley Bank. Additionally, there may be a mismatch between the duration of assets and liabilities. New Zealand's fixed mortgage duration is usually short-term, therefore customers can refinance quickly if competitors offer lower rates. This creates ongoing repricing risk, liquidity pressure, uncertainty around future lending margins, and funding stability. However, if the OCR remains the same or falls, our mortgage pricing remains too high, we could lose market share, weakening customer relationships and slowing lending growth at an important time. I would support a hawkish perspective with a balanced pricing strategy on short-term fixed mortgages while continuing to closely monitor swap markets, liquidity conditions, and refinancing activities.
Fukai, how do we respond to those risks?
For the retail banking side, my main concern is how customers will react to our mortgage pricing. Many households are under pressure because their older low fixed rate terms are ending and their new repayments are much higher, so customers are very price sensitive, especially for 1-year and 2-year fixed rates. I understand that hawkish view. If inflation stays high, the OCR and funding costs may stay high as well. So we should not cut rates too much because that could hurt our margins. But if our rates are too high, good borrowers may refinance to other banks. We could lose mortgage business and long-term relationships, so as supports a balanced strategy. Keep pricing disciplined, but the over-targeted competitive rates are strong existing customers. This helps protect margins, retain customers, and supports lending growth.
Let's open up the discussion before moving towards a final decision. Han Zhang, how concerned are you about the competitors discounting mortgage rates more aggressively for the next months?
It is a real risk, especially for shorter fixed terms where customers can refinance easily. Swap rate and wholesale funding costs are still uncertain. If we lower mortgage rate now to chase market share, but funding costs rise again, our margin could be squeezed very quickly.
But if our rates are much higher, some good borrowers may leave when they refix.
Yet, we also can't ignore the fact that wholesale funding costs may remain elevated more than what the market expects. Prioritizing market share may cause issues later.
Alex, where do you stand on this? Could the balance sheet absorb a competitive pricing strategy?
Well, only to a certain extent. My concern is that inflation may still be underestimated, and if inflation is persistent, the OCR could stay higher for longer and swap rates may continue to rise. In this scenario, funding costs could reprice upwards faster than income we receive on existing mortgages, creating significant margin compression and pressure on the balance sheet resilience.
Okay, but there is also a customer risk if we stay too cautious. We should avoid large discounts, but still use targeted offers for existing customers.
That's a fair point, but New Zealand banks are particularly vulnerable to repricing risk because borrowers tend to fix for short periods, and customers can refinance quickly, which increases uncertainty around the future margins and funding stability.
Tiffany, do you believe the markets may still be underestimating the inflation risk?
Well, that is a real possibility. With inflation above the RBNZ target midpoint and sticky domestic pressures and high oil prices and geopolitical uncertainty, there is a real risk of inflation rising. And if this happens, markets may price in an OCR hike rather than a hold. This will drive up swap rates and wholesale funding costs, and underpricing mortgages would damage our balance sheet far more than maintaining a slightly conservative pricing strategy.
I think the committee is reaching a clear consensus. We need to remain competitive enough to retain customers while still protecting the bank against margin pressure and funding risks in uncertain interest environments. The committee therefore agrees to adopt a cautious but selectively competitive mortgage pricing strategy while inflation remains persistent and fund costs are still elevated. We recognize the importance of remaining competitive in some aspects. The bank will therefore remain relatively disciplined on pricing on shorter fixed-term mortgages while remaining selectively competitive to support customer retention and lending growth. Going forward, we will continuously closely monitor OCR expectations, swap rates, wholesale funding costs, and competitive pricing before any further adjustments to our strategy. Thank you. That concludes our meeting today.